So here is a little primer and understanding on valuing real estate companies on Equidam, right? So real estate companies are a bit peculiar. And by real estate companies, I mean companies that are a substantial part of their revenue and cash flow is working with real estate, right? So either renting out buildings or buying big properties and selling them, right? So first of all, we need to set the retail, the industry to real estate, right? There are a number of industries with real estate, obviously being such a huge industry. So, but if we're talking about rental and development, right? And this is coming from a conversation that I had this morning, trying to understand this type of companies. The cash flow, right, is going to be revenue going to be from incoming rentals, right? And we can simplify this a bit and have a certain growth, right? And let's make the simple case that we have one property. The investment that I'm going to have to do in that property is quite substantial, right? So $1 million in rental value, probably like 100 million in or like 10, 15 million in investment, right? And then, of course, I'm going to have the cost. So I'm going to have capital expenditures here. Let's say that I finance this with a loan, okay? And then I pay back the loan at the rate of maybe $500,000 a year, right? So this is a 20-year loan. This is how it should be set up, right? And then we start to have questions. We can go here on basic input, so we don't have to worry too much about these other things for now. And then it results in a negative valuation, right? So even if I have positive, like it can sometimes result in a negative valuation. Negative valuations are a natural result of calculations where cash flows are not enough to support the company, right? So you see here, have negative cash flows everywhere. This is probably because some of these costs are like, let's say the company does a positive, right? They have a maintenance cost of the building and cleaning and so on, right? They have some salaries for the people in the management of this company, as well as some marketing, right, to reach out to tenants and so on, right? So this is like just some simple numbers to see what would be the effect, right? We are still in a negative valuation, and this is important to understand, right? To understand why. So we go check advanced settings, right? We see that actually all the methods here are negative. All the financial methods are negative, right? So we need to investigate deeper in financials. And so we are returning $500,000 of capital every year. So even if our company is profitable, it is still generating a negative cash flow because we are returning all this capital, right? Plus we have interest on that loan. So now we need to go look into this actual numbers. The interest here, like if this is the interest, right? So about 15%, then obviously our rental income needs to be a lot higher, right? So what we can do is we can assume that we are actually getting a very favorable loan at around 250K of interest, maybe. Let's see if this is gonna change the outcome. We are still on a negative valuation and we still are negative on all methods. So this is not... Oh yeah, and of course we have receivables. We're not going to have inventory, right? So these are all working capital. These are all parameters that are affecting the valuation. It's very unlikely that we have $500,000 of payables on these little costs, right? So I would say maybe 50,000. And because our costs are remaining fairly fixed, our payables are remaining fairly fixed as well. Whereas on the receivables, it's probably a portion of our rent is receivable. So this doesn't look too bad, actually. We're still negative, and we're still negative every year, right? So now we see that we need to touch that profitability, right? We fix pretty much everything that is fixable, but then our profitability is still not enough to sustain this business model, right? And here comes the elephant in the room. So the question of, okay, this building is also increasing in value. Where do I see that, right? And we will answer that. But let's first try to get to a positive valuation, right? So here we need probably something like that. And here we need probably something like that in terms of numbers in order to justify the investment. And now we have only the VC method negative. This is our first hurdle, right? So VC method requires very, very high returns because venture capital investors are investing in high risk companies that have high returns. And that's where our calculation basis comes from, right? So one thing that you can choose to do here for real estate companies and for companies in general where the VC method doesn't really apply is to remove it, right? So in this case, if the company does really real estate development, rental, buying and selling of properties, like 90% of the cases, this should probably be deactivated. And then we can distribute the weight of the VC method into the other methods, or just go 25% on each method. Either solution is valid. Is valid here. Okay, so now we got to a value of 2.2 million for this company, right? This company that operates one building, it bought it with a loan, and now it's renting it out, right? So then the question is, where is the value of the building in this valuation, right? The building is worth 10 million, but then the value of the company is only 2, right? And the easy thing to see here is that this building was bought with a loan, right? So the value is not going to be in the equity. What we're calculating here is the value of the equity. So if the building has been bought with a loan, then its value is not going to be in the equity, right? If we do buy it with our own money because of some, because the company has cash flow, where do we see the value of the building? Where? Well, if the company has its own money, it's not going to have to have 10 million in a loan, right? So it's not going to have this negative cash flow of 500,000 every year, right? So in this case, we can see that the valuation, oh no, sorry about that. The valuation is not going to change likely for the full amount, unless we're very lucky with the numbers. No, so the valuation only changed to 2.8 million, right? So in this case, why, right? We bought a building for 10 million, and now the valuation is only 2.2. So here we have some options. In order to show the value of the building here, we need to make sure that the business model of the company run its course and the cash flow of that building comes in somewhere, right? So before it was coming in because of the loan, but now that the loan is not there, the cash flow of the building is not there. So we have some choices. We can either extend these projections to the point where the building is sold. So let's say we make 5 years of projections and we decide to sell the building at some point, right? So we don't want to sell the building on the last year of projections, because if we do that, the models are extrapolating from that year. They are extrapolating a lot of data, right? They are extrapolating whatever happens to the company after that year from that year, right? And it's so we cannot have like the sale of the building. So remember, we bought it for 10 million, right? So now we're gonna sell it, right? We're gonna sell it then in year 4, let's assume, because we don't want to sell it in year 5. And let's assume we're gonna sell it for 12 million, right? So then this revenue here becomes 13,800, right? And then I'm gonna save, and I'm gonna obviously have a much higher valuation, right? So in this case, we're going to have a valuation of 4.4. Probably we need to go look at the discounted cash flow valuation already higher. So we could, in this case, deactivate these methods as well. The issue here, right, is first of all that this type of increase doesn't justify the discount rate of the future cash flows is higher than the appreciation rate of this building, right? So if we just do it in this way, then we have, in a sense, destroyed a little bit of value, because the company has a risk in terms of discount rate that is higher than the appreciation of the building. So the other thing to take into account is that what happens here is that afterwards the company doesn't have a building anymore, right? So then I need to go in. Well, if the company wants to continue its business model and like sells the building at this point, right? I want to buy another building at this point or before, right? But let's say I buy another building for another 10 million, right? And in this case, we would have a full business model of the company. And as you can see, the valuation doesn't change that much. So if the company plans to continue fairly steadily in terms of number of buildings, then it almost doesn't matter when you sell it, as long as when you sell it, you buy another one. It does matter if the strategy is to pick buildings that are arbitrage opportunities, right? So buildings that are extremely undervalued by the market for some reason that the company can reliably pick and then can sell for a growth of the value that is beyond what you would expect for that type of risk, right? So in that case, the value, this process of buying and selling buildings can add to the business model. So if you want to do that in your assumptions, right? You can do that by increasing the value at which the building is sold, and then of course keeping the value constant at which you buy the next building, right? So this is just sample numbers, so the math is not perfect. But if you truly are working on something like this and you sketch out your financials and you sketch out proper building appreciations and what you can expect from the real estate market and so on, this is the principles behind how to value real estate companies. So the idea is have enough years to flesh out the business model. When you do sell a building, think about the fact that this is a portfolio, so you probably also have to or you can acquire new buildings. If you don't, then your future cash flows are going to go down as well, right? You want to have the last year representing a fairly normal year of the company, so you cannot have a big building sale or a big building purchase in the last year. Unless you do one of those every year, then that becomes a regular situation for the company, because this situation is going to be extended for the whole future. And you should probably pay attention to the VC method, probably remove it. So that's what we can learn about real estate valuation in Equidam.